Investors Chronicle.
Companies and markets show on the docket today. Commodities commotion. Alex Hamer joins the show to talk through some of the more niche commodities under threat posed by sanctions to Russia. After that, we look at the M&A space and ask whether the current climate has led to a more safety-first approach from buyers. And finally, I'll be joined by Michael Fahy to talk through his feature, Travel Industry Bears COVID Scars. Let's get into it. Hello. Thursday, 17th March. The time is about 3:30 as we record. And delighted to be joined in the studio by three people, which I think is a record, and one over the internet. I've got Alex Newman here. Hi.
Hi, John. How you doing?
Good, thanks. Mark Robinson.
John, how's it going?
Yeah, good, thank you. And Alex Hamer as well.
G'day.
And then over the line, Julian Hoffman again. Hello.
Hello, John. Always a pleasure.
Good to hear from you, Julian. Before we get going with our roundtable discussion, the latest from the week of news. 4 Russian-focused companies will be evicted from FTSE indices from the start of next week, with Evra's shares being completely frozen following sanctions on majority stakeholder Roman Abramovich. Mary McDougall has the write-up on Evra's uncertain future. Petropavlovsk, Polymetal and Raven Property Group are the other 3 companies in question, with the latter today announcing they've suspended trading of shares and plans to delist. Meanwhile, yesterday saw the Federal Reserve hike interest rates for the first time since 2018. The 0.25% is expected to be the first of many this year in the quest to tackle inflation. Today, the Bank of England followed suit, with borrowing costs now up to 0.75%. This week, we've had companies' results from Brooks Macdonald's, James Fisher's, Spirax Sarco, National Express, Close Brothers, Fevertree, etc., etc. We've got write-ups available in our magazine and on the IC website. We were going to bring you Chris Akers on DFS results this episode, but unfortunately he's called in sick, much to my annoyance, as I had a great armchair expert gag lined up. Get well soon nonetheless, Chris. Finally, a quick look at market movement. Positive week in Europe and the US. FTSE 100 putting on around 200 points since Monday. Worth mentioning the Hang Seng has been on a bit of a roller coaster this week, down 10% at one point before rallying on news of Chinese state support. Right. That's all the headlines, I think. On with the show. We're going to start with the continued commodity crisis from the war in Ukraine with our very own Alex Hamer, who's been on top of it. There's been lots of talk about oil, steel, nickel, etc., and you've written about a lot of them. But this week you've picked out a few of the more niche commodities under threat as well.
Yeah. I think it is quickly worth looking at what has happened in the big ones, as you say, namely oil and gas and nickel. Boris has obviously gone to the Middle East to ask for greater oil production from MBS and his equivalent in the UAE. Hasn't happened. We're still a bit, short of oil and gas. A visit from Boris probably wasn't going to fix that immediately. But we're actually seeing a lot more pressure on companies who've used the excuse of investors demanding a lot more returns in recent years, especially in the States, as an excuse to not put more cash into expanding production or even continuing production at similar levels. That talk's starting to change, especially with, continued windfall tax pressure. So there should be changes there. Obviously, this won't have an immediate impact. And I think it almost is a backlash against the vibe that ESG concerns have been largely responsible for our current crisis, and lack of investment in oil and gas. This has obviously had an impact, but is not the main thing. So yeah, that's kind of the current situation with oil and gas. Obviously, prices dip every time there's news of a slight breakthrough in peace talks, and then the Russians blow up another theater full of children, and then the prices go up again. But looking at the kind of secondary impacts, it is actually a really interesting space where these things that we rely on for, seemingly minor operations. So, for example, I've gone into detail looking at helium. Obviously, there's a lot of it around, but actually, capturing it is the tricky thing. And most helium production in the world comes from natural gas production as a byproduct. And the market's been really tight for a few years now. There was hope that a Russian plant in Siberia, in the Amur region, was going to start up last year and kind of add probably 25 to a quarter to a third of new production. It caught on fire, not ideal. Caught on fire again in January, and now a helium kind of expert told me that there's very little chance that'll get repaired given the current sanctions. And helium, while important for floating balloons and fun things like that, that's about 8% of global demand, is critical for semiconductor production. It's used in MRIs. It's used in cloud computing, where you replace air with its nitrogen oxygen mix with helium, and it actually increases the energy efficiency of big computing centers between 20 and 40% because less heat is conducted and you need to cool it less. So helium, really important. We need more of it.
Is it Russia that produces most of it, or is that?
Well, it's tricky because it's almost as if Russia was going to, and then now it won't.
Okay.
So there's a slight nuance to it, but
It's Texas, isn't it? Is the main source for helium in the world?
yeah. So there's a federal repository that has been in big trouble for probably over a year now, where they've had to shut it down over safety concerns. But that's kind of been the kicker that's driven the market into this undersupply situation. And now, there are a few little projects that are coming on. There's a primary helium site in Tanzania where they could just start production on that, but it's quite early stage. There's a South African project that is coming together, and Robert Friedland, the man who was involved in the discovery of Oyu Tolgoi, who's got Kumua, one of the biggest copper discoveries in recent years. He's got a platinum mine in South Africa. So, sorry, a bit roundabout here, but he's just invested in this helium company in South Africa as well to power his mine with natural gas. But that's we're not talking about that side of it. But there is massive interest in this space right now. To I guess cap off the helium side of things. Basically, we need it. There's not enough, and this is going to get worse, and it's going to roll into the existing impacts on semiconductors, which are that market's already struggling.
It's neon as well, isn't it? I think something like half of neon production comes from Ukraine. That's really bad for semiconductors as well.
Yeah.
With that, it's going to be bad for them without it.
Yeah, they like neon. Yeah. And so that's a big one that I hadn't really thought about helium before. I've kind of there's one company on the London Stock Exchange and a few others globally, but it's pretty minor until now, until you don't have enough of it. And I think another thing that I've looked at is uranium. Obviously, the uranium market has mostly had a down few years. Now, with years of supply cuts, probably not an increase in demand massively, but a decrease in kind of that demand destruction has slowed down. And now Russia not being part of the global network of uranium. So there is some uranium production. A lot of uranium production comes from Kazakhstan and Canada, but Russia enriches a third of all uranium through Rosatom. And while not sanctioned yet, it's about to be, possibly, who knows, but the market certainly thinks so. Spot uranium prices have gone over $60, which is a high for many, many years. Even a month or 6 weeks ago, it was trading about $40 a pound. Now it's over $60. So there are real impacts there.
So what's the impact of that? Sorry, Alex, to interrupt. Is it the enriched uranium that gets sent to people's power plants in various countries? Is that the significance of it?
Yes, and the uranium market is slightly more complicated than the oil market, for example, where only, I think, a third of uranium trades on the spot market. But the rest of it is contracted over longer term. But this kind of knocking out a significant part of that I guess value chain more than supply chain you'd call it, will have an impact. And it might only be in a few months, but people are already buying up stocks in readiness for shortages. I don't know what buying spot uranium will do for if you can't get it enriched, but speculators will speculate.
Well, hopefully we get to a situation where the Iranians increase their ability to enrich uranium, which is on the cards. It's a strange sort of market, actually.
Armageddon input.
When you look back at it...
Looking on the sunny side, Mark, eh?
Well, exactly. It's realpolitik, Julian, as you know. And you think about 35 years ago, that market was fairly tight then. And I think it went into a long-term decline, at least in terms of prices, because of the decommissioning process that was agreed between Gorbachev and Reagan. A lot of enriched material reached the domestic market, and that held prices in check for the longest time, really. I guess the commodities that you mentioned up to now as well, what I find interesting is that the situation in Ukraine, and in fact the pandemic before, has sort of laid bare some of the structural faults in these markets as well. When you were talking about crude oil there earlier, and it is interesting that Boris came up with a blank in Riyadh, and allegedly the Saudis didn't even take Biden's call. I don't know how true that is. It seems extraordinary if that was the case. But it actually raises questions about the true extent of Saudi spare capacity. It's always been a problem because the statistics that come out from the Desert Kingdom have always been open to question. And I think when hopefully when this comes to a speedy conclusion on the security front, it will engender some new thinking in terms of security of supply. I mean, it's already doing that, obviously, but the situation was probably a little bit more dire than we thought originally.
Sure, yeah. And can you imagine if this had happened pre the shale revolution and the US was still completely reliant on the Saudis and Russians for supply? I guess, they can go back to Venezuela, they can go back to Iran, but this is, I think, going to knock, Russia's the third largest or equal second largest supplier of oil. This is going to be a really big impact. And even if it's not, if Europe and others haven't sanctioned Russian oil, the sanctions are going to hit in other ways. So I think the IEA is already forecasting, I think, a quite quick 3 million barrel a day cut to global supply, which is about 3% of global supply, because of the other sanctions that aren't even directly targeted at oil.
Is that stuff like spare parts that you suddenly can't get on the market anymore?
I think it's more related to the financial side of things, but that spare parts issue will start to hit. I mean, even now, even though spare parts are available for someone like the Norwegians, they're pushing back maintenance to get supply at its complete maximum right now, and that will have kick-on effects around the corner too.
We've not even mentioned nickel.
Yeah, we haven't dug into nickel too much in the magazine this week, because if you boil it down to the impacts on an everyday investor, they're not huge. The LME has really struggled to get a handle on this, and I think they suspended trading again today because the prices were wanting to do things they didn't like.
They actually went further, didn't they? They cancelled a load of trades, didn't they? Or at least completed contracts.
So last Tuesday morning, when we got to the famous or infamous $100,000 a tonne mark, they cancelled a bunch of those trades and then basically rewound it to Monday night. So they're saying, I think 48,000 a tonne is acceptable, but 100 is not. And I think this is, you've got metals traders and energy traders as well screaming out for a hand, because the system that they've been working under is not working right now. But is someone at a nickel mine, say Glencore, actually getting $100,000 a tonne? No, it's not how this is working. I mean, Glencore's traders might be doing well or screaming. I mean, Trafigura has had financial issues because of this trading scenario. But yeah, for an average investor / someone who needs a bit of nickel to build some steel, the effects aren't massive, I don't think, right now.
Well, thanks, Alex. That's your article. The other commodities hit by war is it's available now. Magazine website. You know the drill, listener.
At all good browsers.
On all good browsers. We're going to move on now. Julian, you emailed me earlier in the week to say you wanted to touch on some takeover attempts that one or two have fallen through recently, and it's led to the question, I suppose, that whether in the current climate buyers are adopting a more safety-first approach.
Yeah, thanks. I mean, it's an interesting phenomenon at the moment because takeovers certainly last year or the third quarter of last year were running very hot. I mean, we did a whole thing about how private equity was getting involved and everybody was buying up FTSE 100 companies. Obviously, that happened in the case of Morrison's. But since that point, and it's literally really in the last 3 months, the market has gone very quiet in terms of takeovers, and there are a couple that are on the slate at the moment that look increasingly at risk of not going through, I would say. I mean, we already had Spectrus's bid for Oxford Instruments pull out, or Spectrus pulled out of that, citing an uncertain market conditions, uncertain future. And the other one that seems to have run into the sand is the bid by National Aviation Services, which is a Q80 company, for John Menzies, which is a heavily sort of impacted aviation support services group here in the UK that obviously got clobbered by the effect of the pandemic. But that seems to have run into the sand. So I just looked it up, and the takeover panel has extended the deadline for which NAS has to make a put up or shut up offer to the 30th of March. So basically, it looked like it was done and dusted at sort of 608 pence a share. And everybody was going to go away happy and, bathe in champagne. But that seems to have completely turned around, and there is a question really whether there is whether the M&A market now, in expectation of the fact that interest rates are going up everywhere now.
Yeah, I think that there's always been this direct correlation between the cost of capital and the M&A market, and it may be the case that the involvement of private equity will diminish over time if the Fed keeps on hiking interest rates over the coming year or so.
Yeah, I mean, absolutely true. I mean, we can only really await developments, certainly in the case of John Menzies. But I mean, you wonder how many others are going to get cold feet. And the one that I thought we could talk about in more depth really was the Pearson potential Pearson takeover by Apollo, which is actually a private equity firm out of New York or based in New York. And they basically went for Pearson at 800 a share in November. That got rejected. They're now up to 854 pence a share, and the board is kind of umming and ahhing. But basically, they've got until the 8th of April to sort something out. Basically, that's their deadline. But I just wanted to open it up. I mean, Pearson used to be the owner of the Investors Chronicle, and I don't think we've ever failed since they sold sold us actually as an entity to have a good kicking at that company. But I just wondered what people's thoughts are about whether what they think about the takeover, whether the Pearson is really up to continuing as an independent company, or whether the shareholders should just put up their arms and say, well, nothing's worked over the last decade and we'll just give up and sell out.
Well, firstly, I don't think we're that petty, are we?
Speak for yourself, Mark.
I've never covered Pearson, oddly enough, but I think it's clear that there were some, with the benefit of hindsight, no doubt, some management decisions that they'd rather regret going into markets that didn't prove nearly as lucrative as they initially hoped, I guess. The educational market in the US stands out on that basis. But Alex, you've probably got a better idea of this than I do.
Well,
I'm not going to get sued anymore.
I wouldn't. I mean, I was only an employee of Pearson for a year and a half, so I suppose any special grudge against the company didn't rub off too
There's no grudges,
much
there's
on
no
me.
pettiness.
But I mean, the interesting thing about this Apollo deal, I suppose, compared with the Menzies NAS one, is at least judging by what Apollo said last week, that they made their final offer in March. In other words, after Russia's invasion of Ukraine, and I suppose this huge risk, this added risk premium, which has been added to any takeover or just equity valuation at the moment with everything so uncertain. I mean, Pearson, it's not quite so terribly in the crossfires as other sectors. I imagine, John Menzies as a proxy to aviation growth is probably a bit more of a dicey situation here. But it is interesting that Apollo has said that they're still looking at it. And that's post the huge dollop of uncertainty that's come in the last 3 weeks. But yeah, I mean, the Menzies deal was at least seemed to be signed and sealed on the 21st of Feb, and then 3 days later we had the terrible events started to unfurl. So yeah, I think that to me looks like the one to watch. It looks slightly more slippery, but yeah, I mean.
I have a question on PE and kind of a bit more history, and as for context, I'm reading Barbarian to the Gate right now, and your cost of capital through this PE rush in the mid to late 80s was what, 15%? Like interest rates at 15%. I mean, they managed it then.
Yeah, I think there were for brief periods though that wasn't right
Okay.
through the latter part of it. I mean, they spiked it. They spiked the base rate at certain points too. But yeah, I mean, my first mortgage that I had was something about 8.5%. I'm sure there's plenty of people out there that in a similar boat.
This is where we start the generational warfare.
It was hard in my day. It was hard in my day when houses could be bought for £12,000. Yeah.
But it is true. I mean, there's plenty of people of working age now who've probably never experienced interest rates other than single figures and low single figures at that.
Plenty of, I mean, not Apollo, but plenty of poor little PE firms that are going to have a rude awakening.
Yeah, you'd think. PE should still be able to prove itself as the masters of the universe with, rates at under 1%. If they can't, if they're so dependent on, zero interest rates, then what is the point of them? But
the model was slightly different going back to the 1980s and late 1970s as well. We're talking then really about the practice of asset stripping, and there was.
I mean, they were all conglomerates that you could break up.
Well, exactly, and beyond that, the privatized industries as well were ripe for that.
And then you've got the
approach.
A lot of the what would you call it? The pitch around the purchase of Stagecoach by the German fund, and their logistics business is like, we really want to run buses around Lincoln. We love that model and we want to keep it going. And I mean, that's what they've done. They bought a Belgian bus company and kept it running.
And turned around.
They're around a roundabout.
Not the actual bus.
It must have been one of those bendy buses. Well, I mean, it's interesting about that conglomerate question. I mean, you wonder really, the other thing that might happen if interest rates go up quite a lot is whether companies will start looking at the conglomerate model again as a way of, I mean, that was a way in the 60s and 70s of diversifying your inflation risk, basically. And the thing that was interesting about it is I looked up the number of assets at one time that they owned, and they owned the Financial Times, which obviously includes Investors Chronicle at that point, Penguin Books, Royal Doulton Crockery, Crown Derby, Thames Television, The Economist, Madame Tussauds, and Chessington World of Adventures. so you've got a pretty big spread of potential businesses there.
It's the classic crockery inflation hedge, isn't it?
Yeah, exactly. It's really quite funny. I mean, the thing I found interesting was that basically Pearson got rid of all of those over 20 years. basically starting with Marjorie Scardino when she took over, and but they sold everything for basically for peanuts. So basically, Chessington World of Adventures and Madame Tussauds gets turned into Merlin Entertainment, and that gets bought up for like 6 billion at one point, and they sold it for peanuts. And the same thing happened with another company they owned. That was a financial reporting company, Merger Markets, and they flogged it off for 300 million or something, and now it's worth over $1 billion. And the question really is the management at fault for not being able to run those very diverse businesses, or is there a real problem with owning too much stuff? I think that's probably the issue, isn't it? I mean, and we don't know. I mean, they've become very focused on a education market, but they don't seem to be very good at that either, if it makes any sense. And you kind of wonder whether they shouldn't just sell it up.
I don't know if it's a loose segue, but I was also interested by, Alex, you writing earlier in the week about AMC buying into a gold miner as well.
I think Adam Aaron has read all his literature, read all his own literature, and is very excited about being a meme stock lord, and wants to share that love with until now a completely abysmal mining company. I saw a nice poll on Twitter asking people which company they thought was worse. I think Highcroft won out slightly, won 52% or so of the vote. I mistakenly waded into the ape. So AMC shareholders call themselves apes. I won't explain why. They're weird. And I mistakenly waded into their conversations on Twitter, and it was all, there's 15 million ounces of gold in the ground. This company has to be worth $60 billion. And yeah, I guess it was a rude awakening, or not a rude awakening, but almost a surprise to see that not everyone understands that refractory ore is quite difficult to mine, and you need to build a POX plant, as London shareholders of Petropavlos Polymetal have discovered in recent years. But I mean, best of luck to the owners of Highcroft. They've lost most of their money in recent years, and ideally they've sold out yesterday.
Right.
Isn't there the definition of a gold mine, Alex? Basically, a hole in the ground with a liar standing next to it.
Or a cinema chain owner now standing next to it. Yeah.
Yeah, and I mean, he went to visit it, and they do have a bit of a hole. Like, it's not an operating mine. They tried that a bit last year, and it didn't work that well. But yeah, he got to put the hard hat on. He got a colourful vest. They might have given him some boots. I'm sure he loved it. Yeah, it's kind of an amusement park for CEOs who've just wasted $20 million.
I think Matt Levine made this point in his newsletter this week. But I mean, the meme stock thing in a year of war, continued pestilence and what else? It's sort of you wonder when it's gonna run aground. But I mean, financial markets are big places, aren't there? There's room for this kind of mania. But
yeah, I mean, in the announcement of the purchase, Adam Aaron mentioned the success of Spider-Man recently and the Batman in recent weeks as well, and maybe good shares will start becoming like art house films, and then you've got the Marvel efforts to. No, it's a bad analogy, but
it seems a little bit odd when you look at the impairments that came about through BHP and Rio, and all that's within
when they bought a cinema chain.
Well, yes, of course, when they bought Hoyts in Sydney. Yeah, so I mean, are we going to see another series of rash purchases in the market while commodity prices are bubbling away, or is it a case of once bitten, twice shy?
I suppose we shouldn't contradict ourselves too much as well, having just argued ourselves into the point of a conglomerate.
Yeah.
That is actually the obvious thing for
I don't think anyone's
cinema operator to do.
I don't think anyone's tuning in here for consistency. At least I hope not.
I think it would make more sense to me if they bought a good one.
Yeah.
Or they invested in a good one. But it's good that you mention the big miners and M&A options, Mark, because our cover in about a month will be explaining that in great detail. and I'll have a good answer for you
It's a
then.
fabulous segue, that one.
Well,
the
always,
future.
always be selling,
Yeah. Well, that's normally my job. Well, thanks all. I think that's all we've got time for, so we'll leave it there if that's all right. But stay tuned, listener, for my quick conversation with Michael Fahy on his feature on the travel industry post-COVID. So joining the podcast now is Michael Fahy. Hi, Michael. How are you?
Hey, John. I'm all right, thanks. Yeah, good.
Good. You've written a long read this week. Travel industry bears COVID scars is the title.
Yeah.
And fairly self-explanatory. You're looking into the travel and tourism industry. And yeah, I have to say it does feel like the industry has done come through COVID remarkably unscathed. But obviously, as you look into in your article, it's not quite that simple.
No, this was an interesting one to look at because and I start the piece talking about the kind of early images. I mean, the first thing that everybody remembers is the shots of maybe Chinese city Wuhan in lockdown. But then following that, it was the cruise ship, the Diamond Princess, which there were those kind of rolling news images of it being quarantined in this port in Yokohama in Japan, as the case numbers seem to just spread all the way through the ship. And when you looked at it from that point of view, and you saw lots of other cruise ships being turned away from ports and airplanes being grounded and shut out from certain markets, it seemed like this was something that could possibly maybe change the industry forever. And yet here we are 2 years later, most people are quite happily planning for the summer holidays and wanting to get away, or just wanting to go travel to see friends and family somewhere where they've not been for ages. And when you speak to quite a few of or you see what the airlines are saying, what the cruise operators are saying, they're all quite bullish about things returning to normal. Well, I mentioned in the story that Ryanair is putting on something like 115% of capacity of 2019 capacity for this year, so more flights than it had pre-COVID. You have other operators like Wizz Air doing similar things. So in many ways, it looks like, there are very few airlines that have gone bust. All of the major cruise lines are still going and in operation. So in many ways, it does look like the industry's come out of it unscathed. But it's not quite as simple as that, as we say in the piece. Both in terms of tourism and also for the anybody operating in that kind of holiday leisure sector.
Yeah, I mean, you dig into our vessels of travel, I guess. You know the airlines and the cruise ships. Maybe you could go into a bit more detail on them. I mean, on the airlines, as you say, not many went under, but some have had to do some major restructuring and things like that, haven't they, to stay afloat?
So I spoke to IATA, the International Air Transport Association, the industry association, and got some numbers from them. And there were in total something like 90 airlines have gone bust, which sounds like quite a lot. But then there have been also a lot of startups in that time, and quite a few have been recapitalized. In many instances, governments stepped in places like Germany with Lufthansa, in France with Air France KLM, because it was pretty clear. And even in the US, a lot of the major US airlines got backing from the government. And there are some kind of long-term implications of that. There's quite a famous quote, I think it's from Warren Buffett, about how you make a fortune in the airline industry, how you make a small fortune in the airline industry, and it's to start with a large fortune. The industry it's never been the most profitable. And now that they're saddled with these huge amounts of debt, again, IATA is saying something like the amount of debt that airlines are carrying has gone up by 200 billion to 650 billion. And that is going to weigh heavily on a lot of the operators in the industry for quite a long time.
What about cruise liners? Because you devote a good portion of the article to them as well.
Yeah, so in a similar sort of fashion, the major cruise liners, the likes of Carnival and Norwegian and Royal Caribbean, have taken on massive amounts of debt. I think in Carnival's terms, they took on another 20 billion and have had to do a couple of equity raises along the way as well. And the interesting thing I found with cruise liners, and when you look at both airlines and cruise liners, the things they have in common is that they have to plan years in advance for some of the capital outlays, for the new planes that they're bringing in on board and the new ships. And in some ways that gives them a little flexibility. So you have this massive hit to demand, but if you've ordered ships or planes 4 or 5 years out, there's not really a great deal you can do. You can do some rescheduling in terms of timing, but you've already committed to the spend. And so it seems with the cruise liners, particularly a lot of the big shipyards that serve them are still doing reasonably okay. Now, with airlines, it's slightly different. You've got Airbus and Boeing has the airline orders have fallen last year, or the orders for new airplanes have fallen last year, but not by a massive amount. And it's also difficult to untangle some of Boeing's own industry problems, which we've talked about previously in the magazine, with the kind of general fall in demand. But yeah, for cruise liners particularly, it's going to be quite a tough road back. It's, again, they're very bullish on demand. I think Carnival was saying that bookings for the latter half of this year were as big as they were in 2019, and in revenue terms are even slightly ahead for the back half of this year and early next year. In capacity terms, the cruise liners are talking about having all of the ships back out onto the water by this summer. So yeah, it's that thing of operationally, it looks like things are going to get back to normal fairly quickly, but there are still a lot of issues that need to be dealt with in terms of debt and restructuring maybe further down the line.
Mm. And the final sort of piece of the puzzle that I just wanted to touch on this podcast is the hoteliers as well. And I was struck by that quote you write in the article that Bill Gates was worried that 50% of business travel could be arranged. And then you follow that up by saying hoteliers have actually been boosted by corporate get-togethers, which I thought was quite interesting. It's sort of an unforeseen result of COVID working, I guess.
Yeah, I mean, there's no doubt that the pandemic has been bad for business and corporate travel, and that the ways of working have changed. The fact that I'm speaking to you now over video conferencing software means that the technology and the way in which businesses work means that there's probably going to be less corporate travel. And again, for airlines, that's an issue because some of them earn up to a third of the revenue from the corporate travelers sat in the lovely expensive seats at the front of the plane. For hotels, obviously, you have the trade. They're based around weekday trade from corporate and weekend trade from leisure travel. So the hotels probably weren't as badly hit as the cruise lines and the airlines, which had to shut down for large periods. Some hotels did shut down for a little while, but they could gear their offers more towards the leisure customers at the time. But yeah, as you said, not everything that happened in the pandemic is a bad thing for them. And if we're doing that kind of hybrid working, where we do 2-3 days in the office, and 2-3 days at home, or less for some people, and they may only come in to do a team meeting every couple of months, then there is an opportunity there for hoteliers definitely to go after that business corporate travel segment and that large get-togethers. I think in the article we mentioned that Marriott's chief highlighted an event that Salesforce had in New York, and I think they had 5,000 staff for a week, which generated 25,000 room nights for them. And that is probably the type of thing that maybe wouldn't have been done as much before the pandemic.
Mm-hmm. Well, thank you very much, Michael, for that little preview. You can find the full article. It's about 2,500 words, Michael, something like that.
Roughly, yeah.
That's in the magazine this week, and of course on our website as well, on our IC website. Michael, thank you very much for joining me. We'll catch up with you again soon.
No worries. Thank you, John.
The Companies and Markets Show was edited and produced by me, John Rogers. And don't forget to get in touch with any questions or comments or feedback on the Companies and Markets Show. You can reach me at john.rogers@ft.com. That's john.rogers@ft.com. We'll see you next week.